Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
Look at the tape. Just look at the tape from Tuesday, February 24th, 2026. Off-exchange short volume hit 3,669,067 shares.
Yeah, which is massive.
It is massive. That represents 63.31% of the total off-exchange volume for the entire day.
Right. And keep in mind, we are talking about a company hovering between a $5.4 and $5.6 billion market cap. Yet the dark pools, these private exchanges where the big institutional players trade, are just flooding with bets against the stock.
They are, and it looks like chaos.
It looks like the plumbing of this market is showing immense stress, actually.
Well, I acknowledge the stress, and I see those short volume numbers, but you're focusing on the noise of the plumbing while completely missing the architecture of the house. If you stop staring at the dark pools for a second and look at the actual registry, the ownership list, you see a completely different story. You see conviction.
I see conviction too, but conviction in the wrong direction.
Let me finish the point on the registry, though, because Vanguard, the Vanguard Group, has increased their position by 24.63%. They now hold over 33.9 million shares. That is nearly 11% of the entire company. So you're analyzing short-term hedging algorithms, and I'm looking at high-conviction, permanent capital accumulation.
Boris, you're looking at the largest asset managers lending those exact shares out to the shorts to collect a yield. It's the oldest trick in the book. They buy the stock, they lend it out for a massive fee because the stock is hard to borrow, and then they hedge their exposure.
We can certainly get into the lending mechanics, but let's establish exactly what we are debating today. The company is CORZ Scientific, ticker CORZ, and the central question we are tackling is whether this is still just a legacy Bitcoin miner, subject to the whims of crypto winter, or, and this is my thesis, if we are witnessing a seminal case study in the re-rating of digital infrastructure. I believe this is a complete metamorphosis into an AI and high-performance computing foundation, and we are just days away from the Q4 earnings report on Monday, March 2nd, which I think will completely validate this Phase 2 growth strategy.
And I come at it from a very different angle. While the AI pivot is, the narrative that Wall Street absolutely loves to sell right now, it's the sexy story, the reality on the ground is fraught with execution risks. We are seeing significant delays in Denton, Texas. We are seeing extreme volatility. The stock has a beta of 6.87.
Right.
That is not a stable infrastructure play. That is a casino. A beta that high means the stock moves almost 7 times as violently as the S&P 500. So my argument is that the market mechanics, specifically that off-exchange activity we just cited, suggests that the smart money is actually hedging against the potential failure to execute this pivot.
I think you're mistaking volatility for a lack of quality. Look, in high-growth transitions, volatility is just the price of admission. Let's look at the ownership architecture again because it has fundamentally changed. In early 2026, we aren't looking at a retail-dominated meme stock anymore. We are seeing a real shift to institutional stability. I mentioned Vanguard, but it's not just them. Look at the recent filings. Trivest Advisors initiated a new stake worth $6.56 million. Oaktree Capital Management added 1.95 million shares late last year.
Oaktree is distressed debt, usually. If Oaktree's there, they know how to pick through bones. They smell blood, not flowers.
They are value investors who understand hard assets. These firms are not speculating on the price of Bitcoin next week. They are underwriting the scarcity of power. CORZ Scientific has 1.3 gigawatts of power. In a world starved for energy to run AI models, where every single hyperscaler is desperate for capacity, that power is the asset. They view CORZ as an infrastructure-rich special situation. They are betting the company can convert that power into stable, high-margin hosting revenue. That is exactly why you see a 24% jump in Vanguard's holdings. They are moving it into broader technology benchmarks.
That's a compelling narrative, sure. But let's look at the plumbing again. You talk about ownership. I want to talk about who is actually moving the stock right now. The short interest is currently at 58.25 million shares. That is 25.41% of the float. That is an incredibly crowded trade. Think about that. 1 in every 4 shares available for trading is sold short. And the days to cover metric is hovering between 6.78 and 6.90 days. That creates a total powder keg.
Which could trigger a massive squeeze to the upside.
Or a massive collapse if the earnings miss. But look deeper at who is facilitating this volume. We see G1 Execution Services, that's an affiliate of Susquehanna, and Citadel Securities dominating the off-exchange flows. Susquehanna holds over 17 million shares equivalent, but it's mostly derivatives. They're using the dark pools to manage the delta on a massive options book.
You're getting into the weeds of market making here.
The weeds are where the truth is. This isn't just investing in a growth story, it's complex arbitrage. When you see 63% of the volume moving off exchange, it suggests that market makers are selling from their own inventory to meet demand, a technical short, or they are hedging against that beta of 6.87. It tells me that the market simply does not trust the price stability here. They are treating it like a volatility instrument, not a utility.
I think the market is just digesting the transition. And that brings us to the core of the debate, really. The asset base versus the operational reality. Because you can talk about derivatives all day long, but at the end of the day, you cannot fake 1.3 gigawatts of power.
You can't fake the power, no, but you can certainly fail to deliver the computers that actually use it.
But look at the strategy. They have a grid support strategy where they monetize that power by shutting down during peak times to lower costs. It's brilliant arbitrage of the energy markets. And regarding the AI transition, they currently have 590 megawatts contracted to CoreWeave across 6 sites. That is tangible. That is real revenue. In a power-starved world, this infrastructure is worth multiples more than the legacy mining valuation. They are basically sitting on the oil fields of the 21st century.
I'm sorry, but I have to stop you there because you are completely glossing over the Denton, Texas reality check. You talk about these 590 megawatts as if they are already printing cash. Let's look at the actual project status. There are reports from December and as recently as this month, February 2026, regarding the Denton facility intended for OpenAI. It is facing significant delays.
Construction delays happen in every infrastructure project. It's concrete and steel. Things happen.
These aren't just minor hiccups. Weather-related delays and design revisions have pushed the project back by several months. And this has real consequences. CoreWeave, the partner you are touting, had to publicly lower their own 2025 guidance specifically because of temporary delays related to a third-party data center developer. That is CORZ. It proves that converting a Bitcoin mining site into an HPC cluster is incredibly difficult.
It is difficult, but they are doing it.
Are they? Think about the physics involved. A Bitcoin mine is essentially a warehouse with fans blowing air over ASICs. It's rugged, it's dirty. If a miner overheats and shuts down, you lose $50. An AI data center for OpenAI requires Tier 3 standards. It needs redundant cooling, humidity control, dust filtration, and 99.999% uptime. If a training cluster goes down, you ruin a $100 million training run. The delays in Denton prove that this isn't a simple copy-paste job. It is highly prone to bottlenecks.
It's not easy, no. I'll grant you that. But the demand is so incredibly high that the customers aren't going anywhere. OpenAI needs that compute. Meta needs that compute. The backlog at CoreWeave is $55.6 billion. CORZ is the landlord for a chunk of that. A few months of delay in Texas doesn't erase the fundamental value of the lease itself.
It erodes confidence, though, and it raises the question of whether the management team actually has the expertise to deliver Phase 2.
I think the management team is exactly where the next bullish point lies, specifically regarding the activist factor. We have to talk about 2C's Capital.
The architects of the peace treaty.
The architects of shareholder value. 2C's Capital, owning 6.7% of the equity, is the reason CORZ wasn't sold for scraps. Remember the CoreWeave buyout offer in October 2025? They offered between $12.35 and $18 a share. 2C's correctly identified that as a take-under. They blocked it,
And on February 18th, just last week, they signed a cooperation agreement.
Which effectively locks up the board.
It refreshes the board. Chairman Jordan Levy is out. 3 new independent directors are joining, with the first one coming by March 15th. This is a massive governance win. It ensures the company is run for the shareholders, not just treated as a cheap vendor for CoreWeave. It aligns the company with enterprise-grade standards, which is exactly what you need to attract the likes of BlackRock and Vanguard.
That is a very optimistic spin on a standstill agreement. I view it entirely differently. 2Cs has agreed to a standstill through 2027. Sure, it buys peace, but it also creates immense pressure. By blocking the merger, they have forced CORZ Scientific to go it alone. Independence sounds great until you look at the balance sheet. Building these HPC centers is capital intensive, extremely capital intensive.
They have a clean balance sheet post-restructuring.
They need to raise up to $4 billion to fund this growth. Where does that come from? If they stay independent, that means a debt overhang or, much more likely, dilution. The merger would have solved the capital problem immediately. Now CORZ has to survive on its own capital. And with the delays in Denton, the cash flow from those new contracts is pushed to the right. That creates a gap that might need to be filled by selling more shares, which hurts the very shareholders 2C's claims to protect.
I disagree that dilution is the only path, especially with the revenue estimates we are seeing right now, which brings us to the upcoming catalysts, the March 2nd earnings report.
Monday night,
the analysts' expectations are set at $118.44 million in revenue. But more importantly, this company has a history of beating estimates. In Q3 2025, they beat EPS expectations significantly, and the stock rallied 7% because of it. But the key metric I am watching, and the main reason I remain bullish, is the pipeline for new clients.
Outside of CoreWeave.
Exactly. There are 400 megawatts of capacity targeted for 2026 delivery to non-CoreWeave hyperscalers. Trip Miller from Gullion Capital, a very smart guy, was quoted in January saying they are close to landing several new deals. If they announce a major contract with a new hyperscaler on Monday, it validates the entire independent thesis. It proves they aren't just a CoreWeave dependency.
Close to landing is not landed. And this is exactly where I worry about the GPU fleet risk and the technology curve. You are building infrastructure for chips that exist today. If construction takes too long, like we are clearly seeing in Denton, by the time you flip the switch, the hardware might be facing obsolescence. You're building a Ferrari garage, but by the time it's done, everyone is driving hover cars.
That's a bit of a stretch. Data center power is agnostic. The chips change, the power requirements simply go up.
But the cooling and the density requirements change rapidly. It's a real risk. And there's another risk that we haven't touched on enough, the market structure risk. Have you seen the new ETF, the TRAD 2X long CORZ ETF, ticker COZX?
I've seen it. It adds liquidity.
It adds chaos. It seeks 200% daily exposure. This amplifies that beta of 6.87 we talked about earlier. When the stock moves, these leveraged funds have to rebalance. If the stock goes up, they buy more. If it goes down, they sell. It exacerbates the moves. And the market makers, Susquehanna, Citadel, they have to hedge this.
Which could trigger a gamma squeeze?
Exactly. If the earnings are good, the hedging activity could force a buying frenzy that disconnects the price entirely from reality. But the inverse is also true. If they miss on revenue, or if they announce another delay in Texas, the deleveraging from these products could flush the stock down faster than you can blink. That isn't fundamental investing. That is structural fragility.
I see it as a structural opportunity. A gamma squeeze to the upside driven by good news and high short interest is exactly what created fortunes in other tech pivots. The put-to-call open interest ratio is 0.34. The options market is heavily bullish. They are betting on the upside.
Or they are selling calls to collect premium from the optimists.
I don't think so. The 24% increase in Vanguard's position tells me the smart money is long. They are looking past the volatility of a leveraged ETF. They are looking at the 2026 and 2027 power contracts.
Well, we will see on Monday. But let's wrap this up. We've covered the assets, the activists, and the plumbing. Where do you land?
I land firmly on the side of the transformation. Look, Phase 2 value creation is already underway. It is backed by the largest asset managers in the world, Vanguard, BlackRock, Trivest. You're focusing on the plumbing and the short-term hiccups in Denton. I am telling you, those are minor operational details compared to the macro scarcity of 1.3 gigawatts of power. The rejection of the buyout was the turning point. CORZ Scientific is being re-rated from a minor to a hyperscale partner. The market is just beginning to price that in.
And I remain the skeptic on the execution. The transition to a neo-cloud provider sounds extremely promising in a pitch deck, but it is fragile in reality. The dark pool data, 63% off exchange, heavily shorted, shows that sophisticated players are hedging against the very real execution risks we see in Texas. Investors must look past the AI label and watch the actual operational delivery in the March 2nd report. If they don't show tangible progress on the 400 megawatt pipeline in a real fix for Denton, that short interest is going to be proven right.
That is what makes a market. Monday night will be very interesting.
It certainly will.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.